Welcome to Bloomberg ETF IQ. I'm Tim Stenovec.
And I'm Katie Greifeld. And Tim, we have a huge week ahead of us.
Yeah, big week for earnings after last week's sell-off. Rates reset. This week, who knows what's in store?
There is a lot to get to. So let's get to now the biggest stories in the more than $12 trillion global ETF industry. And we start with an executive shakeup at Global X, plus the closure of some ETFs. We'll be speaking with the new CEO of Global X, Ryan O'Connor, about the recent turnover.
And BlackRock laying out plans for its first mutual fund to ETF conversion, joining a growing list of asset managers who've made the jump.
And speaking of BlackRock, we'll discuss fixed income and the future of the Fed with Rick Rieder. But before we get there, as always, Eric Balchunas from Bloomberg Intelligence here with us now, looking at the flows. Eric, what do you have?
Thank you, Katie. Tim, the flows show a little bit of a reversal for the trading crowd. Last week, we went over that only the Vanguard bid was coming in because the traders were a little spooked, but they are now piling back in. That's a good sign if you're an equity bull. SPY at the top, the Qs are third, right? Again, those are the highly liquid ETFs used by traders. 2 and 4 are more of the sort of advisor Vanguard bid, and they're seeing flows. So when you have that mix of traders and retail and advisors, that's a good sign that like everybody's at the party, at least for now. And Soxal is interesting. This is a leveraged ETF that's invests in semiconductors or trades it. 1.2 billion is an insane amount for that fund. It's because when semis go down, leverage crowd likes to pile in to play the rebound. So the more semis go down, watch that to take in more and more flows, people trying to play a reversal. Interesting there. So let's look at the outflows. And one thing that sticks out to me besides small caps at the top, IWM is one of the ETFs seeing outflows and is the bond ETFs. So we got small caps, which again, just can't ever get going, maybe someday. And then we've got a bunch of bond ETFs in there. If I were to show you the returns of those, they'd all be negative this year. So the bond market is just not as exciting as the stock market right now, and so you see the outflows. Now, speaking of exciting, let's talk about thematic ETFs, which, you know, we have this year where equities are up, but thematic ETFs haven't really come back and gotten this huge second bite at the apple yet. You look in 2020, they took in 45 billion. 2021, 48 billion. That's almost 100 billion. That was a massive 2 years. Then, you know, this was the rough year. To just not only see 2 billion is pretty good. So they held up well. But this year, you'd think they'd have taken in more than losing 4 billion. That said, there are a couple winning stories. Robotics and AI, blockchain, tech, of course, cannabis and psychedelics, even taking in some inflows, and infrastructure. Those are the winners within the thematic category. But all told, Katie, Tim, still outflows. You'd think with these equity markets, we would be seeing more inflows into the themes.
Yeah, flows not necessarily following performance here. And speaking of thematics, I'm really excited for this next conversation because let's bring in now Ryan O'Connor. He is the CEO of Global X. And before we get to thematics, we need to talk about what's happening at Global X. I know you started about 11 days ago as CEO.
Day 11.
But since November, Global X's past CEO, the COO, the CIO, and the head of finance and several other executives have left the company. What's going on?
Look, first of all, thank you for having me. It's a pleasure to be here, especially on day 11. There's nowhere else I'd rather be. Look, there's a couple things that I would say. First of all, you know, turnover is, in my view, a natural part of any leadership transition. From our perspective, this is going to allow us to do a couple of things. One, we have a very deep bench as it relates to the DNA of ETF people at Global X and giving opportunities to folks to step up and really help take us to the next level. The second thing that we'll be able to do is where we need to, we'll inject external talent to help us get to the next level. So I think that's an important point to make. And the final thing that I would say is it's not just about the people, it's about the platform and the business performance. And from our perspective, we feel as though our business has never been stronger. Just hit an all-time high in terms of AUM, crossing the $47 billion mark. We have, on a flow basis, eclipsed this year all of our flows combined from last year so far this year. So feeling pretty good about where we're at, and we're going to continue to take this platform to new highs.
I do think some observers would say this is more than typical turnover when it comes to a leadership or an executive transition, given all the folks that Katie just mentioned. What would you say to those folks, and to what extent, I know you just mentioned some flows, but to what extent are you concerned about this type of turnover dissuading folks from investing with the company?
What I would say is I have, in the time that I've been at Global X, been absolutely impressed and blown away by the team that we have internally. I have a ton of confidence in all of our folks. And, you know, I believe and I see our clients continuing to stick by us and continue to invest with us. So from our perspective, really excited about the platform. feel as though the team we've got is the right one, and where we need, we can augment that team.
Let's talk about the acquisition that happened. So Global X was this sort of indie startup thematic issuer for many years, and then you were bought in 2018 by a foreign firm, right? So you're bought in 2018, and we look at the flows over the last 10 years. Word on the street is they were unhappy with the flows after 2021. But the thing is, you guys took in $21 billion that year, which wasn't a great year, but everybody had a great year. It was 2021. Everything was up a lot. The next couple of years were $3 billion, $2 billion, $3 billion. But everybody came down a little bit. How much of this is that, where the inflows dropped off, as you can see, versus sort of other issues? And does the parent company need to be a little more patient?
Well, the one thing that I can say the parent company you mentioned is Murray. My interactions with Murray has been wildly exciting so far, and all points indicate that that is going to continue. The way that I think about our relationship with Murray is really the best of both worlds, is how I look at it. We continue to have a very strong and entrepreneurial culture in Global X. However, we have the backing of a big, broad, global asset manager, which, by the way, is an ETF company. Global assets under management in Murray are roughly $120 billion. There's not a ton of $100 billion plus ETF managers out there. The things that they bring to us, I think, is going to help us to continue to scale and grow over time. So I'm excited about that, Eric.
Well, Ryan, now that you're in the seat, day 11, let's talk about the plans going forward here. And let's talk about headcount, both when it comes to your product lineup and also the people involved. You mentioned that you're pretty happy with the team that you've got, but I know that Global X, you laid off employees in early 2024. You also closed 19 ETFs in January. Do you have more layoffs and product closures plans?
Great question. And the way that I specifically on the product closure conversation approach that is, it is the responsible thing to do for any ETF provider to constantly assess and prune our ETF offering as and when we need to. And I don't see Global X as being really an outlier in that respect. So we will continue to assess the funds as we need. But again, being an innovator, as we feel as though we are and will continue to be, takes a bit of courage. So over time, we will stay committed to our funds, but where we need to, make commercial decisions as necessary.
What's the criteria for you to look at a fund and say, okay, this is one that we're thinking about closing?
The way that I have thought about that and the way that we've spoken about it internally tends to be in timing increments, similar to how many of our clients think about it. So doing a deep dive assessment at the 1, 3, 5 year and beyond mark is kind of how we have framed the product management component of it. But the other way that I would answer that is we're constantly evaluating based off of what our clients need and look to for us. So that's how we would think about that.
Okay, one place where I think you might have dropped the ball a little is QYLD. Even though it is your biggest ETF, this is a covered call ETF.
Correct.
Came out 10 years ago. All of a sudden, JP Morgan comes out, calls it equity premium income, and it takes off. Same thing. Now, you've gotten a little bit, but they got so much. How much is that sort of annoying you, and how much are you putting into the sort of trying to get revenge on them with the covered call ETF?
So the way that I would think about that category is I love to see that category grow in the way that it has. I really do. I would make the distinction, though, Eric, around the idea of an active strategy versus a passive strategy. And be clear, our strategy is passive. So in our conversations with customers that do want the specific passive exposure, QYLD, we still feel like is a very, very good option there. So first point is love to actually see the growth in the category. Second point is we feel like we're going to continue to participate in that growth. And then the third point is you will see us continue to innovate within that category. So more to come there.
Well, speaking of more to come when it comes to the product lineup, something I'm wondering about is when I think Global X, I think thematic funds, for example. That's really your bread and butter, what you're known for. But with, of course, this turnover, this shakeup, of course, you're newly installed. Is the strategy going to change? Is Global X still going to be primarily a thematic shop?
So the way that I see our thematic expertise, I completely agree with you. I see our thematic expertise as being broader than that, frankly. You are going to see us continue to innovate, not only in thematic space, but beyond. Eric mentioned income. There's a number of sources of disruption there. I think from a thematic perspective, we have got a first mover advantage, and many of these segments that Eric has already highlighted have had some success this year. I think it's important that we continue to take advantage of that first mover advantage, and that story that clients have come to us for, we think remains resilient. So we definitely want to continue to be known as a thematic issuer, and we will innovate on top of that.
Speaking of first mover, you were not a first mover when it comes to spot Bitcoin ETF. It happened before your time, but you guys pulled the application for a spot Bitcoin ETF. Was that a mistake? Do you wish they hadn't pulled that before you got there?
The view around that and the way that played out, to me, makes a ton of sense relative to how we thought about our product offering and ultimately our business, which is one around, I've used the word innovation. The other word I will use is differentiation. I think it's difficult to differentiate in that space, as you well know. We have done a lot of thinking about how you can differentiate around that space, as we have others. And that's a very long-winded way of saying, no, I don't see that as being a mistake. And yes, I see our approach as being aligned with how we thought about it otherwise. Yeah.
And just real quick, I showed earlier that robotics AI is the big theme, right? So how much resources are you putting into it? And help clear up the confusion. Bots is robotics, and then you have AIQ, which is AI. What's the difference?
So AI is something that we talk a lot about, of course, not just from a fund perspective, but from a business perspective. And the one thing that I would hone in on AIQ is we have the only pure play AI fund, which is over $1 billion. So from our perspective, to answer the first question, Eric, we are spending a lot of time thinking about it, talking about it, and amplifying that message to our clients. And we see that trend continuing to persist.
All right, Ryan, really appreciate your time today. Hope to speak with you again soon. Again, appreciate the time, especially on day 11. I know it's pretty busy over there. Ryan O'Connor, he is the CEO of Global X. Now coming up, BlackRock laying out plans for its first mutual fund to ETF conversion last week. We'll discuss next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with the Magnificent Seven. You're taking a look at MAGS here. This, of course, is from Roundhill. It only tracks those top 7 stocks that have been so magnificent over the past year. You can see this ETF is up almost 48%. Of course, it is a consequential week for big tech. You can see that this one has taken a little bit of a leg lower in recent weeks. So keep your eyes peeled on this ticker, of course, as we get deeper into those earnings reports. But let's talk about active versus passive as well. It's something we talk about all the time on this program. And this flip happened a little while ago, basically that you now have active assets in mutual funds and ETFs, or rather passive. That's your purple line, overtaking that in active. You can see it's very close, almost 51% to about 49%. But it's interesting, if you actually take a look at a longer term chart, AUM in both categories has been growing. But continuing the conversation of mutual funds versus ETFs, this is one of my all-time favorite charts. In orange, you have mutual fund outflows. In blue, you have ETF inflows. And really, it's been a zero-sum game, Tim, when you take a look at the direction of traffic in terms of where investors are actually putting their money.
Yeah. Investors are pulling money out of mutual funds, $65 billion out of mutual funds so far this year, more than $250 billion into ETFs this year. Managers are forced to adapt.
Big time. And I mean, you've seen it time and time again. Even the most old school asset managers having to come forward and introduce an ETF strategy. And I mean, even the likes of BlackRock being the biggest ETF issuer, they actually unveiled their plans for their first mutual fund to ETF conversion last week. So BlackRock is very aware of this.
And only 3 years since the first one ever.
Yeah, indeed. Yeah, mutual fund to ETF conversions. They have been picking up the last couple of years. And I mean, asset managers are also looking for other ways, such as multi-share classes. They've been asking the SEC to do that, basically looking for any way to stop the bleeding in mutual funds and also capitalize on what's going on with ETFs.
Yeah, we'll see what the SEC says about that.
Stay tuned.
All right, stay tuned. Well, speaking of staying tuned, still ahead, we're going to stick with BlackRock and talk with Rick Rieder all about his ETF. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Tim Stenovec, along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence, back with us now for today's drill down, where we focus on one ETF. Eric, hit it.
Katie, today we have BINC, the BlackRock Flexible Income ETF. This is a actively managed bond fund by Rick Rieder, who we're going to talk to in a second. It's a year old. You can see it came out last May. 40 basis points. That's pretty cheap for active management. Especially this kind of active, it's a little more looking for lower tracking error. It's got 2.8 billion. That's a lot for a year. So this thing is off to a good start. This thing is trying to get something different. It's trying to get returns that are different than the benchmark. Let's look at the holdings of this, and you can see what I mean here. This thing is going to have a lot of exposure to many different things. It's heavy on corporate mortgages, only a little bit of treasuries in there, a little bit of government securities. The duration's about 2.2 years, so it's on the lower side. And then the high yield, you can see the double B and the B. It's about 37% high yield, so a lot more than the ag in terms of that. Let's look at it versus the ag and versus IUSB, which is the BlackRock ETF that has, it's the ag plus, it's the universal, has some high yield in there. It's blowing away the ag, definitely blowing away the universal. I threw high yield, HYG, in there. You can see high yield is why, one of the reasons it's performing well. But considering it's only 30% high yield and it's almost near high yield, that's a pretty big win, Katie. So returns like these, not surprised, is an early hit.
All right, Eric, thank you so much. And joining us now to talk about this ETF, I'm thrilled to say we have Rick Rieder. He is Global Fixed Income CIO over at BlackRock. And Rick, I don't need to tell you that it has been a crazy time in the bond market. And you think about BINC and how you've been structuring the portfolio. I mean, how has that changed as we've seen yields on, feels like everywhere across the curve, just really skyrocket over the past couple months?
Thanks, Katie. Thanks for having me on. So a couple of things. First of all, we've brought down our interest rate exposure. We were running about 3/4 of a year longer than we are today. We're running, as Eric said, just over 2 years of interest rate exposure. We're keeping our interest rate exposure in the front to the belly of the yield curve. And the reason why, I think we're pretty close to flat for the year. The ag's down, I think, over 300 basis points. You know, it's just keep income, and you don't need to go out the yield curve because the all it's taking is volatility into the portfolio. So what we're trying to do is keep our income high, and we're running almost. We use a metric called horizon rate of return, which looks at what yield should you capture. It's almost 7%, so it's about almost exactly the basis point what it is in high yield. But we've been running at about 2/3 the volatility because it's much higher rated. Implied rating is high triple B, almost single A, almost low single A. So the idea is diversify, keep a lot of income, don't take a lot of interest rate risk, and just move it around. I mean, at some point this year, I think we're going to increase our interest rate exposure depending on the inflation data we get. But for now, let's just clip coupon and just make it through what is a tough rate period.
Hey, Rick, you said move things around, so I'm just curious about how nimble you are and in terms of how active of a role here. Are you talking when you hear from Jay Powell last week with this idea of a rates reset, you're going in and you're changing asset allocation that day?
Yeah, it's definitely active. I mean, I think the beauty of this for an investor going into it is we're trying to manage our interest rate exposure, and if we think, which I think will be the case this year, we're going to get to a place where we anticipate the data improving, and I do think over the next month or so you're going to get better inflation data. We'll start extending our interest rate sensitivity, and then the big thing for us, versus a straight high yield portfolio, is move to where the opportunity is. Like, for example, today we're running probably more European high yield than we've run historically. It's because as a dollar investor, you get an extra 150, 160 basis points of what's called a cross-currency, additional yield for being a dollar investor. So it's just trying to tactically allocate, use securitize, use mortgages, keep your volatility down, keep the quality and liquidity of the portfolio up. And it's, fixed income is a pretty esoteric. There's so many different assets you can utilize, and just use as many as we can to try and keep our yield up, but manage the volatility for people.
Yeah, and Rick, just looking at the portfolio, I did notice more securitized debt. The high yield, it actually looks like has come down a little bit, but again, 37% is pretty significant. What are you picking within that bucket?
It's a great question. So first of all, more Europe than I've run historically because of the currency. And by the way, we're keeping our European high yield in the front, short of the 2 to 5 year part of the curve. You carry really well. We like the carry to volatility there. And then, in high yield, quite frankly, a lot of the high quality high yield's not interesting. The spreads you can get yields that are close in investment grade. It's not worth it. So the sweet spot today, high yields in the single B category, and then triple C's. You're talking about a lot of volatility introduced to the portfolio. So what we're doing, cut the high quality U.S. high yield, cut the tail of the bottom off, and then try and use your investment teams to figure out in single B where's your sweet spot. So anyway, the idea of being tactical within the asset class, I think, is pretty key for us.
So that's the story on credit risk. I actually want to talk about duration risk a little bit more because you made the point that at some point you'll move out depending on the inflation data. You expect that it'll become, a little bit better in upcoming prints. But how much of that decision on duration depends on when you think the first rate cut from the Fed will be? And has that changed in the past month or so?
That's a great question. I mean, yes, exactly that. I mean, listen, I think you're going to get to the place where, this core PCE gets down to 2.5 to, we're running a little hot today, closer to 2 3/4, 280. So, as you start to anticipate that, I still think the Fed would like to get a couple of cuts in this year. It's getting harder for them to do that, but I still think they can. Once you get visibility on a couple of good inflation reports, employment, wages staying contained, then you can start to extend your duration. I mean, the thing that's key today is like, why mess with it? Just keep your income high, keep your interest rate exposure down. But it's going to be a big tool. Like, can you throw off, with a portfolio throwing high sixes type of yield, can you start to get some interest rate exposure, maybe get you some higher total return from that? So, listen, I think we're going to get there. But, that being said, the service level inflation in this economy is too hot. And hopefully it'll come down over the next couple of weeks.
Well, what makes you, hopefully, I think a lot of people are saying hopefully, Rick, but what makes you confident that over the next month or two, as you said, we're going to start getting better inflation data? What are you seeing out there?
In just about a minute.
Yeah, so listen, I mean, there's some things that have created exogenous, auto insurance, health insurance. Shelter comes down with a lag. I think shelter will start to come down. So, you take some of these that have been running at extremely high levels. My sense is they'll start to come, healthcare inflation will start to come down. But you got to see it. To your point, you got to see it. I think you will, but in the interim, it's like just clip coupon and life is good.
Clip coupons and life is good. I'm going to
get that on a T-shirt.
I'm going to carry that with me. Yeah, Rick Rieder, it is always a joy to talk to you. Thrilled that you could make some time for us. Our thanks to Rick Rieder. He is the global fixed income CIO over at BlackRock. Of course, a really interesting conversation because it's not just a big earnings week. It's always a big week for the Fed. So we'll see how BINC continues to fare. But you just can't get enough of ETFs. A reminder that, of course, you can listen to Eric and Joel Weber on Trillions. That, of course, is their podcast that covers the industry. But sadly, that does it for Bloomberg ETF IQ, at least for this week. I'm Katie Greifeld, along with Tim Stenovic and Eric Balchunas, and this is Bloomberg.